Good afternoon, everybody. So my name is Advait, and this year I chose the M&A and Advisory track. My mentor this year was Mr. McWilliams. He's a VP in M&A Advisory, and I want to start by thanking him for the guidance he's provided throughout this project. Today's presentation is titled Deal Structure and Short-Term Financing Risk. The title might sound really technical, but the core question I've been exploring is actually pretty simple and straightforward. When another company acquires another company, how they pay for it matters just as much as what they pay for. That's what this whole presentation is about. Let me start with a concept that surprised me in the early ISM experience. In M&A, everyone ends up focusing on price. What's the valuation? What multiple are we paying? Is it a fair deal? And those questions matter, but what I learned, both through research and through conversations with Mr. McWilliams, is that the financing structure behind a deal is often more impactful than the actual money that you spend on the deal itself. Think about it this way. You can buy a company for a fair price, but if you finance 90% of it with short-term debt at a high interest rate, you've created a fragile situation from day one. On the other hand, a deal that looks expensive on paper, but you're actually structuring it in a very valid way, if it's structured with the right mix of equity, seller financing, earnouts, might be very manageable. The first 24 months after a deal are the most dangerous. That's when integration is happening, when costs are high, and when revenue might dip, and when debt obligations are hitting at full force. Structure determines how much pressure a company is under during that window. That's the lens that I've been using all year. To build my foundation, I spent time researching how different financing choices actually play out in M&A transactions. Four key insights shape my thinking. First, cash deals, meaning deals funded primarily by debt, increase leverage immediately and significantly. The day you close, your debt to EBITDA ratio jumps. That's a real constraint on the business going forward. Second, you have stock deals. Stock deals will reduce the debt burden because you're using equity instead of borrowing money, but that comes with a cost, dilution. People who are existing shareholders, their share will end up being a smaller percentage of the combined company after the deal. Third, we have hybrid structures, which combine cash, stock, seller notes, and sometimes earnouts, and these can balance the two forces. You're not maxing out on leverage, and you're not giving away the entire upside to dilution either. And fourth and final condition is that market conditions do matter. When interest rates are high, the cost of debt is going to be much more, which amplifies the stress of any leverage you take on. That's especially relevant right now, given the rate environment we're in. These four insights became the backbone of everything that I researched. Let me walk you through what I've actually learned since this ISM placement began in August, because it goes well beyond just textbook definitions. The first major area is financing instruments. I came in understanding the basics, debt versus equity, but working through real deal scenarios with Mr. McWilliams pushed me to understand the trade-offs in a much more applied way. Why would a buyer choose a seller note over a bank note? Why would an earnout make sense for both sides? These aren't abstract questions. They come up in actual negotiations, and they have real implications for how risky a deal actually becomes. The second area is risk assessment. Specifically, I learned to think about short-term leverage and interest burdens as dynamic problems, not static ones. Your leverage ratio on day one of ownership is not the same that it'll be in month 18 if the EBITDA ends up growing or shrinks. Understanding how those numbers move under different conditions is what real risk assessment looks like. The third area is scenario analysis. This was probably the most valuable skill I built this year. Rather than just modeling one outcome, I learned to make a build case and then stress test it against a downside scenario. What happens if earnings drop 20%? Can the business still cover its debt service? Does the leverage ratio breach a covenant? That kind of thinking is what separates good M&A versus something that's kind of risky. Now I want to talk a little bit about my mentor experience. So the role that Mr. McWilliams played in my development, because a lot of what I did just describe didn't come from only reading, it came from conversations with him. Mr. McWilliams pushed me early on to stop thinking about M&A deals as purely valuation exercises. He kept coming back to the same theme. The number on the term sheet is almost irrelevant if the structure creates a situation the buyer can't sustain. That reframing changed how I approached every case study and every model that I built this year. He also helped me understand that market conditions are always in the background of every deal. When we were discussing interest rate environments and their impact on leverage acquisitions, he gave me real context from deals that he had worked on. how the same businesses with the same EBITDA look completely different to a buyer depending on what borrowing costs look like at the time of close. The four insights on this slide: the cash deals increase leverage, stock deals dilute ownership, hybrid structures balance risk, and market conditions influence financing stress. Those aren't just research findings. They're conclusions I arrived at through these conversations, and they informed everything that I built. Now, building my financial model. This is where the work got real. I didn't just want to understand these concepts theoretically, I wanted to actually model them. So I set out to build a financial model that could take deal inputs and produce meaningful risk outputs. The key variables I focused on were debt amount, interest rate, and EBITDA assumptions. Those three inputs drive almost everything downstream. How much debt you take on determines what your leverage ratio will end up being. What interest rate you're paying determines your annual debt service, and what EBITDA you're projecting determines whether you can actually cover that debt service. For scenario development, I built two cases. The base case assumes stable EBITDA. The business performs roughly in line with its trajectory. The downside case, but then I have the downside case, where we'll stress test to see what happens if earnings decline 20 or 30% post-close. That's not an unrealistic scenario. Integration disruption, customer churn, management departures. These kind of things happen, and a well-structured deal should be able to withstand that and survive beyond these inconveniences. The last piece was combining quantitative outputs with qualitative judgment. The numbers tell you what the risk looks like mathematically, but judgment tells you whether that risk level is sustainable given the business, the industry, the management team, and the deal rationale. Both matter. Let me show you how the model is actually organized, because structure matters in a model just as much as it does in a deal. The model has four components. First, the inputs layer. This is where you enter the purchase price, how the deal is structured in terms of cash versus equity, and cash versus equity versus seller financing, and the EBITDA of the target company. Clean inputs make everything possible. Second, I have financing assumptions. Interest rate on the debt, amortization schedule, any seller note terms, earnout percentages, and durations. These drive the cost of the deal over time. Third, we have output metrics. This is what the model calculates automatically. Debt to EBITDA, debt service coverage ratio, total debt outstanding, and annual interest expense. These are the numbers that tell you how the deal looks from a lender's perspective and from a risk management perspective. And fourth, risk flags. The model doesn't just produce numbers, it classifies them. Is a 3x debt to EBITDA ratio low risk, moderate, or high? Is a 1.5x coverage ratio acceptable? The risk flags make the output actionable, not just informal. Sorry, excuse me. Now let me walk you through what the model actually shows when you compare the three main financing approaches. Cash deals, meaning debt-heavy acquisitions, produce the highest leverage increase at close. You're borrowing a significant amount of the purchase price, which means that your debt to EBITDA ratio will end up being very high. This will jump immediately, and your interest burden is high from day one. This structure gives the buyer full ownership, though, with no dilution, but it will create financial pressure in the short term. Stock deals are the opposite in many ways. Because you're using equity instead of borrowing, there's no immediate debt pressure on you, but your leverage ratio barely moves. But the trade-off is dilution. Existing shareholders will see their ownership percentage decrease, and if the deal doesn't perform, that dilution was a permanent cost with no real paydown. Hybrid structures will sit in the middle of that. And in many middle market transactions, they're actually the most sensible approach. You take on some debt, you use some equity or seller notes, and then you finance the rest, and you structure earnouts to tie a portion of the price to future performance of the company. This result is moderate leverage, partial dilution, and the best overall risk balance. This is what the deal comparison module in my tool demonstrates widely. My model tracks three core metrics, and it's worth explaining each one because these are the numbers that M&A advisors and lenders actually focus on. Debt to EBITDA is the primary leverage measure. It tells you how many years of current earnings it would take to pay off all the debt. A ratio of 3x is generally considered manageable for a stable business. About 5x is the territory where it starts to get really kind of concerning. Interest coverage, or the DSCR, debt service coverage ratio, measures the business's ability to pay the debt that they've taken on. A DSCR below 1 means that the business literally cannot cover its debt service from the operations. Above 1.5 is generally considered healthy. This metric is what lenders watch out most closely to during the first 2 years after an acquisition. Liquidity is the third indicator, and it's different from the first two. Debt to EBITDA and the DSCR tell you about leverage and coverage. Liquidity tells you about cash on hand and the ability to meet short-term obligations post-close. You can have a manageable leverage ratio and still face a liquidity crisis if working capital is tight and you've used all available cash to fund the acquisition. To make all of this concrete, I modeled a middle market acquisition scenario from end to end. Middle market deals typically range in the values of around 10 million to all the way up to 500 million in enterprise value. This is where a lot of M&A advisory work actually happens, so this felt like the right context for me to take. I simulated a $50 million purchase price with a $10 million EBITDA target and 60% debt financing structure. I then ran the model through its full output, post-close leverage, impact, annual debt service coverage ratios across base case and downside case scenarios. The most important exercise, though, was testing risk under earnings decline. If EBITDA drops 25%, let's say in year one of ownership, what happens to the coverage ratios? Does it fall below the acceptable threshold? Does the leverage ratio actually break a covenant? This is the kind of stress testing that you have to do to make sure you can actually recommend a deal to a client. I also compared the financing stress across all three structures, cash heavy, stock, and hybrid, using the same underlying business. The difference in risk profile are significant and immediate. That comparison is what ultimately informed the tool I built. Which brings me to the final product of my ISM journey. I built a web-based tool called DealGuard Pro, accessible at dealguardpro.base44.app. The idea behind the tool is simple. I take the model that I built in Excel and I make it usable by anyone, evaluating a deal that not just someone who knows how to do it, but a client that's walking into an M&A advisor with no real judgment. They can look at this and clearly understand. It was built as a direct output of everything that I learned this year. The research on financing structures, the mentor conversations about real life dynamics, and the scenario analysis framework. All of it is kind of embedded in how the tool works, and it really reflects my deeper understanding of M&A across this journey. Let me walk you through the functionality specifically. You start by entering 5 inputs: the purchase price of the target, the target's EBITDA, the percentage of the deal being financed with debt, any seller note component that you have, and whether the earnout is structured linearly or kind of tiered, or does it include a milestone or a tiered layout. Then, from those inputs, the tool will automatically calculate 4 outputs: debt to EBITDA ratio, the DSCR, the debt service coverage ratio, total debt outstanding in any dollar amount, and annual debt service obligation, the amount of debt you'd have to pay at each year with the interest rate that you entered before. You don't have to build any formulas. The formulas are built into the website. You don't have to link any cells. You don't have to do any calculations by yourself. They all happen instantly. Then after that, every metric that is calculated from those outputs or that is outputted leads to certain risk classification, low, moderate, or high, based on standard M&A benchmarks. And then after the deal comparison module shows you that risk classification and seller financing structures compared across the leveraging, coverage, flexibility, and overall risk score, all from the same set of inputs. Now that I've finished with my final product, I want to talk a little bit about my personal growth journey in ISM. Beyond the technical output, I just want to talk about what this year actually did for me as someone who wants to work in finance eventually. In terms of proficiency, my financial modeling improved substantially, and I'm not just faster, I actually understand what I'm building and why each input matters. Before this, I'd done Excel certifications and I knew how to link cells and put in formulas, but I didn't know what that actually meant. And now I knew. That understanding is what actually I think makes my model really useful. Then from a risk assessment standpoint, I think beyond valuation now, that was the biggest shift. Before ISM, I thought M&A analysis was mostly about determining what a company is worth. Now I understand that the worth is just a starting point. How the deal is structured is the backbone of literally everything. And finally, from the strategic point of view, I came to understand how structure affects long-term outcomes, not just the financial metrics on day one, but the operating flexibility, the lender relationships, and the management incentives, and ultimately whether the deal creates value, or destroys it over the following years. So my final key takeaways were these 4 key takeaways. First, structure does determine short-term pressure. The financing choices made at close create the constraints that the business operates under in its most vulnerable period. There's no undoing what a costly structure can start. Second, debt amplifies early risk. It's not just that debt adds cost, it adds fragility. A business that could absorb a bad quarter isn't really scared about how much their EBITDA fluctuates, but if you're high on debt, then you end up being very scared. Third, balanced financing improves resilience. Hybrid structures that spread the financing across multiple instruments give the business way more ways to absorb that shock, and that flexibility has real value that doesn't always show up in the initial return calculation. And fourth, advisory judgment matters. The model gives you numbers, the risk flags give you thresholds, but deciding what risk level is actually acceptable for your business in a specific market at a specific point of time, that is judgment. That's what advisors are actually paid for, and that's what I'm working to develop. So that's my presentation. Thank you for your time and attention today. I'm happy to answer any questions, whether about the research, the model, the tool, or anything about my experience in M&A advisory track this year. And again, thank you to Mr. McWilliams for being a genuinely helpful mentor across the entire time. Then I was thinking I'd give him
That's right.
the award.
Spell the word guard.
G-A-U-R-D. Did I misspell it?
G-U-A-R-D.
Actually,
It happens to
my app title is also spelled G-A-U-R-D. I'm gonna have to change that.
So if your app is misspelled, then just kind of point out that it's misspelled.
Okay. Yeah. No, I think I can change it through the domain. Does anyone have any questions?
Other than spelling